Nathan, it seemed we came into this year, there was a very clear narrative of disinflation, but now we've gotten two reports to start the year for January and February that seem to suggest that maybe that narrative needs to be rethought. What did you make of it?
Yeah, I think we're seeing why Jay Powell indicated in his January press conference that he wanted more confidence that inflation was coming down before he started to cut rates. And as you say, the January CPI report was just downright ugly. I'd say today's numbers are probably a notch better, especially in the super core non-shelter services sectors, but are still higher than what the Fed would like to see. And I think that, we're implicitly debating here whether this resilience we've seen in the CPI over the last couple of months, whether this is seasonal adjustment issues and the like and is going to dissipate, or whether it's signaling something a little bit more worrisome. And I think coming months are going to have to resolve that.
Yeah. Well, that's what I'm curious about here. I mean, it seemed that over the last couple of years, what was driving inflation, and for that matter, disinflation, seemed to be relatively apparent. Do you find it a little bit harder to read the tea leaves now as to what's really driving these moves up and down?
Clearly, the disinflation that has occurred was primarily driven by goods prices, and we made a lot of progress there. There's a little bit of a bounce back in this report, but still low inflation for goods. But in parallel, services inflation have been stubborn. And we have been worried for quite some time that the disinflation in services prices is really going to require some loosening of the labor market and further easing of wage growth. And I think bottom line, that disinflation in the services sectors is likely to be a slow slog and a challenge for the Fed. Now, I don't think that preempts or means we won't see rate cuts this year, but it does mean that the Fed's going to be cautious. It's going to wait a while, and then once it starts moving, it's going to move cautiously.
Which is why the equity market rally continues to be a bit of a head scratcher in that, because there is a different two-sided risk now to inflation, right? Which makes me wonder, how much can the Fed cut before they stoke inflation, considering that things look okay?
Yeah. The equity market, the best explanation I can see here is that these numbers we got this morning were challenging, but not as bad as many had feared. And then the underlying story, and I have this discussion with my colleagues who are equity strategists regularly, the underlying story is earnings growth has been very robust for U.S. corporates over the last several years. And that engine of support in the corporate sector remains pretty strong. And as long as you continue to have that robust earnings performance, I think we're going to continue to see a meaningful move forward in equity prices.
Well, Nathan, that's interesting because one of the reasons why Bank of America is more bullish on earnings is because of a reinvestment cycle from big tech companies. Do you guys see something similar? And I relate that back to CPI, because if you get a huge reinvestment cycle, isn't that just going to push up demand and then push up inflation, and then we're in a very different scenario?
I think you tell a story of a robust economy.
Okay.
The question is whether that robustness brings inflation that's uncomfortable for the Fed, or is broadly consistent with this cycle of gradually bringing inflation down. If you look at core PC, we're a little below 3, from the upper 2s to the lower 2s. And I think that there's still enough tightness in the economy that that's a likely outcome. But nevertheless, as you highlight, the economy is solid. The consumer has been strong. And if that's further reinforced by a strong investment cycle, maybe the Fed is going to have less scope to cut than many of us think at the moment.